Most traders think that more screen time, more setups, and tighter trade management equals bigger profits. They believe watching every tick and managing every position makes them professional. I believed that too, until I destroyed over $35,000 proving myself wrong. After 3 years of cycling between brief winning streaks and catastrophic tilt days, where I'd blow up to 5 prop accounts in a single session, I discovered something that went against everything I'd been taught. The solution wasn't found in a better strategy, sharper technical analysis, or even stronger willpower. It was actually the opposite of what every trading course tells you to do. When I finally implemented this counterintuitive approach and added one external factor I'd been avoiding out of pride, everything changed. My tilt days stopped. My account survived. And for the first time in 3 years, I started taking consistent payouts. By the end of this video, you'll understand the specific framework that ended my account blowing cycle and why the thing you think makes you a better trader might actually be destroying your consistency. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Here's what nobody tells you about trading psychology. You can't fix what you won't admit exists. For 3 years, I was the only witness to my trading disasters. Sure, I kept a journal. I tracked my trades in spreadsheets. I even wrote down my rules on sticky notes plastered around my monitor. But when I broke those rules, and I broke them constantly, the only person who knew was me. And I became an absolute master at lying to myself. That wasn't really revenge trading. I saw a genuine setup. I didn't break my risk rule. That position just made sense in the moment. Tomorrow I'll follow the plan. The excuses were endless, and because nobody else could see what I was doing, there was zero cost to breaking my rules. The financial cost of losing money somehow wasn't enough. I'd blow $1,500 in an afternoon, feel terrible about it, and then do the exact same thing 3 days later. The pain of the loss would fade faster than my bad habits. That's when I made the decision that changed everything. I started documenting every single trade publicly, not just the winners that made me look good. Every trade, every rule break, every moment of weakness. I started trading. Live with a small group, expecting that I'd finally have it all figured out. That the camera alone would fix my discipline. I genuinely thought the accountability would make me calm and professional from day one. I was so wrong that it's almost embarrassing to look back at. I couldn't make it 3 days without breaking my rules on camera. But here's what started happening. When I took a bad trade, someone in the comments would call it out within hours. Why did you take 3 trades when your rule is 1? You cut that winner way too early. That wasn't even your setup. At first, it stung. My ego wanted to defend every decision, explain away every mistake. But then I realized something profound. These people were giving me something I'd never had before. They were holding up a mirror to my actual behavior, not the idealized version I told myself about in my journal. And the social cost of breaking my rules became higher than the financial cost of the loss. Admitting to a few hundred people watching that I'd failed again created a kind of accountability that money alone never could. It wasn't shame. It was clarity. I couldn't lie to myself anymore because the evidence was public and permanent. Every video became a receipt of my actual behavior versus my stated plan. And slowly, painfully, the gap between those two things started to close. If you're struggling with discipline right now, I want you to try something. Before the market opens tomorrow, record a voice memo or write a public post stating exactly what your rules are for the day. One trade only. Risk amount. Setup criteria. Whatever your plan is, say it out loud where someone else can see or hear it. Then, after the market closes, do it again. Show your executions. If you broke a rule, explain what happened without justifying it. Just state the facts. You don't need a YouTube channel to do this. A trading Discord, a small group chat, even just one accountability partner. The key is that someone other than you sees the receipts. But here's where most traders make a critical mistake, even when they have accountability. They try to implement discipline, while their nervous system is in complete panic mode. And that brings me to the second shift that saved my trading account. After I publicly passed my evaluation and got into the funded account, I was trading 5 micro contracts. Not massive size, but enough that every tick mattered to me emotionally. I'd watch a position move 10 points against me and feel my heart rate spike. 20 points, and I'd start sweating. By the time I hit my stop loss, I was already planning the revenge trade to make it back. The dollar amounts weren't huge by any objective standard, but to me in that moment, they felt enormous. One of the more experienced traders watching left a comment that seemed almost insulting at first. Size down to 2 micros. I remember reading that and thinking, 2 micros, that's barely worth trading. How am I supposed to make real money at that size? But I was also desperate. I just had that rough day where I lost $400 across 3 trades, and I could feel myself starting to spiral into the old pattern. So I did something I rarely did. I actually listened to advice that contradicted what my ego wanted. The first day trading 2 micros felt absurdly boring. I took my setup, set my orders, walked away. The position moved against me and I barely felt anything. It eventually hit my stop and I was down $52. In the past, a loss like that would have triggered an entire sequence. Frustration, another trade to make it back, probably 2 more trades after that, and before I knew it, I'd be down $300. This time, I just marked it in my journal and shut down my platform. The loss felt boring, and boring was exactly what I needed. This is the part nobody explains properly when they talk about position sizing. They tell you to risk 1% or 2% of your account, and they frame it as risk management. But it's not really about the account. It's about your nervous system. When you're trading size that makes your hands shake, you cannot execute proper discipline. It's physiologically impossible. Your amygdala takes over. Your prefrontal cortex, the part of your brain that makes rational decisions and follows plans, essentially goes offline. You become a different person, an emotional, reactive version of yourself that will break every rule to escape the discomfort. Sizing down wasn't about protecting my account from one bad trade. It was about protecting myself from the cascade of bad decisions that happens when I'm emotionally activated. At 2 micros, the dollar amounts became small enough that my rational brain could stay in control. I could see my stop get hit and think clearly about whether I should take another trade later, rather than immediately jumping back in to recover the loss. The psychological breathing room that came from smaller size was worth more than any potential profit I was giving up. And here's the interesting part. Once I sized down and stayed disciplined for 3 weeks straight, my account actually grew faster than it had when I was trading larger size, because I wasn't giving back all my gains in revenge trading sessions. I went 23 days without breaking my one trade a day rule. 23 consecutive days. I'd never done anything close to that in 3 years of trading. If you're watching this and thinking you can't afford to size down because you need to make money faster, I need you to hear this clearly. That thinking is precisely what's keeping you stuck. I know because I told myself the same thing for years.
I need to trade bigger to hit my profit targets. I need to make this much per day to prove this works. Smaller size won't get me anywhere. Every single one of those thoughts was my ego protecting itself from the humbling truth that I wasn't ready for the size I was trading. The rule is simple. Trade at a size where the dollar loss feels boring. If you can't look at your maximum position loss and feel absolutely nothing, you're trading too big. You should be able to get stopped out and feel the same emotional response as if you'd spent that money on lunch. Completely neutral. Only when you can execute 20 consecutive days of perfect discipline at that boring size do you earn the right to scale back up. And even then, you move up slowly. Right now, I take a moment and calculate this. What position size would make your maximum stop loss feel boring to you? Not uncomfortable, not scary, not concerning. Boring. That's your number. That's where you need to be trading until your discipline becomes automatic. But even with accountability and proper position sizing, there's a third trap that destroys more traders than almost anything else. And it's something that every trading course actually teaches you to do. For my first 2.5 years of trading, I had goals written on a whiteboard next to my desk. Make $200 per day. Hit a $1,000 payout by end of month. Average 300 daily to reach 4,000 in profit for the evaluation. Every trading educator tells you to set goals. Make them specific, measurable, time-bound. So I did. And those goals destroyed me. Here's what would happen. I'd wake up, see my daily target of $200, and immediately the pressure was on. If I took a trade and made $80, I wasn't satisfied. I'd made good money on a valid setup, but my brain wouldn't let me stop because I hadn't hit the target. So I'd look for another trade, and another. And by the time I'd taken 3 or 4 trades trying to hit that arbitrary number, I'd usually given back the $80 and lost another 100 on top of it. Even worse was when the target created desperation. I'd start the day, take 2 losses, be down $150, and now my brain would calculate that I needed to make $350 just to hit my daily goal. That kind of hole made me force trades in terrible conditions. I'd take setups I wouldn't normally take. I'd trade at times I knew were choppy, all because I was chasing a monetary target instead of focusing on execution. The breakthrough came when I removed every single monetary goal and replaced them with execution metrics. My new goals became patience-based and discipline-focused. Wait for my setup in my predetermined zone. Execute my plan exactly as written. Take one valid trade and walk away regardless of the outcome. These weren't about money, they were about behavior. And then I changed how I journaled. In the past, I'd write down the trade details and then immediately calculate my P&L. Made $90 on this trade, down 40 on that one, up 50 overall. The focus was always on the scoreboard. After I shifted my mindset, I started journaling only my risk and my rule adherence.
Yet I'd write, risked $52 on this trade. Followed my plan exactly. Setup was valid, execution was clean. If the trade won, great. If it lost, that was fine too. What mattered was whether I'd followed the process. This created something powerful. I started having days where I lost money, but felt successful, and days where I made money but marked myself as having failed. That sounds backwards, but it rewired my entire relationship with trading. On days when I followed my plan perfectly, but the trade didn't work, I could close my journal feeling good about my execution. The market took my stop, but I'd traded well. That's a win and the only metric that actually matters for long-term success. Conversely, when I broke my rules but happened to make money anyway, I'd mark the day as a failure.
Because I knew that inconsistent behavior would eventually catch up with me. The market had rewarded a bad process, but that doesn't mean the process was good. I was training myself to disconnect the outcome from the behavior and judge myself purely on whether I'd executed my edge correctly. If you want this same shift, here's what you do. Tonight, before you sleep, write down 3 execution goals for tomorrow. Not money goals, behavior goals. Examples: I will wait until the market gives me my setup, even if that means taking 0 trades. I will set my orders and walk away without watching. I will journal my risk before entry and not calculate my profit potential. Then tomorrow, after you trade, the only question you ask yourself is, did I achieve those 3 behavior goals? Your P&L is irrelevant to that evaluation. I do this for 30 days straight, and I promise you'll see a shift. The irony is that once you stop chasing the money and start focusing on flawless execution, the money starts coming more consistently, because you're no longer forcing trades to hit arbitrary targets. You're patient, you're selective, and you only trade when the edge is actually there. Now here's the question I know some of you are asking. How do I stay patient and only take 1 trade a day when I'm seeing multiple setups? And the truth is, in my first 50 days of this challenge, I couldn't. Even with accountability, even with smaller size, even with execution-based goals, I kept breaking my 1 trade a day rule. I'd see that second setup after my first trade won, and I'd convince myself it was different this time, that this setup was too good to pass up, and I'd take it. And often it would lose, giving back what I'd made. The pattern was clear. I had an impulse control problem. The solution wasn't to try harder to resist the impulse. The solution was to remove the opportunity for the impulse to occur in the first place. That's where the circuit breaker came in. My new rule became ruthlessly simple. 1 trade per day. Set my orders, and then physically walk away from the computer. Not just minimize the window. Not just switch to another screen while the platform runs in the background. Actually close the platform, step away from my desk, and do something else. The trade would either hit my target or my stop while I was gone, and I'd check the result later. This wasn't about trust or confidence in my setups. It was about removing my ability to sabotage myself. The first time I did this,
It was genuinely difficult. I placed the trade, closed my platform, and walked into the other room. Within 5 minutes, I was pacing. What if it's running, and I should move my target? What if it's about to reverse, and I could save the trade? What if there's another perfect setup forming right now? The urge to check was overwhelming, but I'd made a commitment on camera. I'd told the viewers I was going to do this. So, I forced myself to wait. 2 hours later, I opened my platform. The trade had hit my target. I'd made $82, and I hadn't watched a single tick. More importantly, I hadn't taken a second trade. I hadn't revenge traded after a loss. I hadn't tried to add to a winner and then watched it reverse on me. I'd simply executed 1 clean trade and walked away. And for the first time in months, I felt in complete control.
That feeling became addictive in the best way. Every day I could do this successfully built a small piece of evidence that I was capable of discipline. And on the days I slipped and broke the rule, the public accountability meant I had to explain why. That feedback loop, combined with the physical barrier of closing my platform, was more effective than years of willpower and good intentions. At this point, some of you are probably thinking this approach is too restrictive. You're imagining all the opportunities you'd miss by limiting yourself to one trade. And you're right, you will miss opportunities. On days when the market offers 3 perfect setups and you only take one, you'll watch the other 2 work without you. That's going to happen.
But here's what you need to understand. Those missed opportunities aren't what's killing your account. The 10 marginal trades you take trying to catch everything, those are what's killing your account. The reality that took me 2.5 years to accept is that I don't have an edge in recognizing every possible trade. I barely have an edge on the one setup I've spent hundreds of hours studying. Every additional trade I take beyond that highest probability setup is reducing my overall win rate. I was trying to be a generalist when the market rewards specialists. 1 perfect trade per day, executed flawlessly with no emotional interference, will compound into real money over time. 5 mediocre trades where I'm forcing setups and managing positions out of fear will just spin my account in circles. If you struggle with overtrading, try this for just 5 days. Pick your absolute best setup, the one pattern you see most clearly, where you have the most confidence. Commit publicly to only taking that setup 1 time per day and walking away afterward. 5 days. Track what happens, not just to your P&L, but to your emotional state. Notice how much calmer you feel when you're not glued to the screen for 6 hours straight. Notice how much clearer your decision-making becomes when you're not fatigued from watching every tick. Before we go further, I want to ask you something. If this framework is helping you rethink your approach to trading discipline, take a second to hit that subscribe button. This channel exists because of viewers who find value in seeing real, unfiltered trading struggles and breakthroughs. And the fact that you're still watching means you're serious about making a change. So subscribe, turn on notifications, and drop a comment below telling me which of these concepts hits hardest for you. Is it the accountability piece, the position sizing, the execution-based goals? Let me know because your feedback shapes what I create next. All right, let's keep going. Now, even with all these systems in place, accountability, small size, execution goals, 1 trade per day, I was still making a critical error that showed up in my results. I was getting chopped up in bad locations. I'd take what I thought was a valid setup on the 1-minute chart, and the trade would move 5 points in my favor, then reverse and stop me out. It would happen repeatedly, and I couldn't figure out why my edge wasn't working, and the answer became obvious once someone pointed it out. I was completely ignoring where I was on the higher time frame structure. I'd spent so long staring at the 1-minute chart that I'd forgotten the bigger picture even existed. I'd take a long setup on the 1 minute because the pattern looked good, not realizing I was directly under a massive resistance level on the hourly chart where sellers had been waiting. Or I'd short into a support zone that was obvious on the daily but invisible on my 1-minute view. This is the trap that 1-minute traders fall into. We get hypnotized by the speed and the action. We see patterns forming every few minutes, and we start believing that the 1-minute chart is telling us the whole story.
but it's not. The 1 minute is just noise unless it's happening in the right context.
And the right context is defined by the higher time frames. So I started doing something simple but transformative every morning before the market opened. I'd look at the daily chart and mark out the major support and resistance levels. Then I'd drop down to the hourly and refine those zones. I'd identify where the market had shown significant reactions in the past, where big moves had originated, where rallies had stalled, where sell-offs had found buyers. Those zones became my map. Here's the critical part. I wouldn't just mark the levels and ignore them. I'd make a rule that my 1 minute setups were only valid if they occurred at or near one of these higher time frame levels. If a pattern formed in the middle of nowhere, in the dead zone between support and resistance, I'd skip it entirely.
It didn't matter how perfect it looked on the 1 minute. If it wasn't backed by higher time frame context, I treated it as noise. The difference was immediate. My win rate improved because I was no longer taking trades in locations where the bigger players were positioned against me. When I'd take a long at a solid support level, the trade would have room to work, because I wasn't fighting the entire structure of the market. And when trades did lose, they'd usually lose small, because I'd placed my stop just outside a significant level, where if the market went through it, the entire thesis was invalidated anyway. This also solved another problem I'd been having. I'd been taking setups at the wrong times of day. I'd see a pattern during the lunch chop and convince myself it was valid, only to watch it fail in the low-volume grind.
And once I started anchoring to higher time frame levels, I naturally began trading less frequently, because valid setups at significant levels don't appear every hour. They appear once or twice in a session if I'm lucky. That forced patience was exactly what I needed. If you're a short time frame trader and you're not doing this, you're essentially trading blind. Tonight, before tomorrow's session, pull up your daily and hourly charts. Mark the 3 to 5 most obvious support and resistance levels. Draw literal lines on your chart so you can't ignore them. Then tomorrow, when you see your setup forming on whatever time frame you trade, ask yourself one question before you enter. Is this setup happening at or near one of my predetermined levels? If the answer is no, skip the trade. Do this for 2 weeks and track how it affects your results. But even when I had the right time frame context, and I was waiting patiently for my setups at significant levels, I was still facing a problem. I was often early. I'd see my pattern forming exactly where it should on the higher time frame structure. I'd enter, and the market would immediately go against me. Sometimes it would eventually work, but only after testing my resolve with a painful drawdown. Other times it would stop me out, and then the real move would happen without me 15 minutes later. This is where the final piece of the framework came in, and it's probably the most contrarian approach I use. I stopped trying to be the first person into the trade. Instead, I started waiting for the obvious entry to fail twice. Here's how it works. Let's say I've identified a major support level on the hourly chart and I'm looking to go long. On the 1 minute, I start seeing the pattern that typically signals a long entry. In the past, I would have entered immediately. Now I wait and watch. If that setup triggers and fails, I make a mental note. Then if a second setup forms, and that one also fails or barely triggers before snapping back, I start getting interested. And if a third attempt comes, and it doesn't even fully trigger, that's when I flip my bias and look for the opposite direction. A short,
in this case. Why does this work? Because by the time 2 or 3 obvious setups have failed, all the traders who took those early entries are now trapped. They're sitting in losing positions, and many of them will exit when the market gives them a chance. That exodus creates momentum in the opposite direction. I'm essentially waiting for the weak hands to reveal themselves through failed attempts, and then I'm positioning for the move that happens when those weak hands capitulate. This isn't a strategy I'd have been disciplined enough to execute in my first year or even my second year of trading. It requires patience that borders on painful. You have to watch what looks like a perfect setup. Resist the urge to take it. Watch it fail. Then resist taking the second one. Watch that fail too. And only then position yourself. Most traders can't do this because the fear of missing out is too strong. They see that first setup and think, what if this is the one that works and I miss it? But here's what I've learned. Missing one good trade is always better than taking 3 bad ones. And by waiting for the pattern of failures, I'm dramatically increasing my probability. I'm not trying to predict what will happen. I'm reacting to what has already happened. Multiple failed attempts in one direction that create the fuel for a move in the other direction. If you want to test this approach, start simply. Just observe for the next week. Don't trade it yet. Just watch your normal setup form. And instead of taking it, note whether it works or fails. If it fails, watch for a second occurrence. Track how often the market eventually moves in the opposite direction after 2 or 3 failed attempts at the initial setup. You'll start seeing a pattern, and once you see it enough times, you'll have the confidence to wait for those failures before positioning yourself. The combination of these 6 elements, public accountability, micro position sizing, execution-based goals, one-trade circuit breakers, higher time frame anchoring, and waiting for failure patterns, completely changed my trading. I went from someone who couldn't go a week without a tilt day to someone who hasn't had one in 60 days. I went from constantly blowing up funded accounts to making consistent small payouts. I went from lying to myself in a private journal to being honest about my mistakes in front of hundreds of people. And here's the thing. None of this is complicated. There's no secret indicator, no advanced pattern, no insider knowledge. It's just discipline applied consistently through a framework that makes discipline easier to maintain. The public accountability creates social pressure. The small size removes emotional pressure. The execution goals remove outcome pressure. The one trade rule removes decision fatigue. The higher time frame context removes location mistakes, and the failure pattern removes timing mistakes. What made this work wasn't that I became a better trader in terms of technical skill. I didn't learn some new strategy or discover a hidden edge in the market. What changed was that I built a structure around my trading that protected me from my own worst impulses. I made it harder to break my rules than to follow them. And slowly, over 60 days of public documentation and accountability, following the rules became the default instead of the exception. Your turn. You don't need to start a YouTube channel if that's not your thing. But you do need to implement the core concepts. Find at least one person who will check your trades daily. Size down to where losses feel boring. Write execution goals instead of profit targets. Limit yourself to your single best setup per day. Map your higher time frame levels every morning. And practice waiting for setups to fail before you position yourself. Pick 3 of these 6 and commit to them for the next 30 days.
Track the results not just in your P&L, but in how you feel during and after the trading day. Because here's what I've discovered. Being a consistently profitable trader isn't about making the perfect trade. It's about making fewer terrible trades. It's not about capturing every move. It's about not giving back your winners with revenge trading. It's not about being right more often. It's about being wrong in controlled, manageable ways that don't destroy your account. The market will always be here. The opportunities will always come back.
What won't always be here is your capital. If you keep approaching this the same way, that hasn't worked. 60 days ago, I was exactly where many of you are now. Knowing what I should do, but unable to consistently do it. The only difference between then and now is that I finally stopped trying to do this alone, stopped trading size that made me emotional, and stopped measuring success by the scoreboard instead of the execution. The framework works. The question is whether you're willing to implement it even when it feels unnecessarily restrictive, even when it feels like you're leaving money on the table, even when your ego tells you that you don't need these training wheels. I thought I didn't need them either. $35,000 later, I learned otherwise. Don't let your ego cost you what mine cost me. I'll see you in the next video. Until then, focus on the process, trust the framework, and remember, you're not trying to be perfect. You're just trying to be better than you were yesterday. And if this framework is helping you rethink your approach to trading discipline, take a second to hit that subscribe button and give this video a thumbs up.